on TV, online and on your smartphone. This is Ticker News.
This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk and financial solutions.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
G'day, I'm Chris Judd and you're watching Talk Your Book, and today we're lucky to be joined by Sonny Bangia from Black Wattle Partners. Sonny, welcome back on the show, and secondly, we catch you at a really exciting time of your career. You're just about to go live with a fund tomorrow, I believe. Tell us about how that's looking.
Thanks, Chris. Thanks for having us on the show. Yeah, we're looking to launch our global equity strategy very shortly. It's a high conviction global strategy that's all country, all industry. And it's, very exciting times for us, given where we are in the global equity landscape. We're just really pumped to launch it with my team, and very excited to be on your show.
Now we'll get into your individual stock pick a little bit, but in terms of your investment style, it sounds like you've got a real bias towards quality names, and just how concentrated will the portfolio be?
Yeah, so the way I sort of like to think about it is we like to buy great businesses that might temporarily have a glitch. The glitch we look for is something that's temporary, so not a structural issue with the business, but it could be just a cyclical downturn, or it could be just a one-off with a client that creates a valuation opportunity and a valuation arbitrage, and then we can actually buy the business at a good time at the right price, so we can have some healthy forward-looking returns. The portfolio itself is quite concentrated. We're looking to buy 20 to 30 high-quality companies around the world, wherever they may present themselves, and then looking to own them for very long periods of time where we can let the underlying business do the hard work for us. So our job is to select them and get them at the right price, and then the business itself to generate high-quality earnings growth over the years and deliver high share price performance. And
what stock did you want to talk about today?
Yeah, I thought let's talk about one of our larger positions called Fair Isaac, FICO. I like to think about it as the original fintech, though it probably doesn't get that label. But we can sort of talk about what they've been doing for the past 60 to 70 years to stay ahead of the game, and why they are still ahead of the game, and perhaps a bit underlooked by the market at the moment.
And give us a helicopter view of what they do and what business units they operate in.
So FICO is in terms of Australian dollars, about a $50 billion market cap. So I think from memory that would rank it probably 13th if it was listed on the ASX. So it's large cap from an Australian point of view, but in the global and American context, it's probably a mid cap, so about 30 billion US dollars. And as I sort of mentioned, it's the original fintech. What they've basically been doing for the past several decades is make credit scoring easier for financial institutions. So they have two businesses. One's a scoring business where they actually score the consumer and give the consumer a FICO score, and that FICO score is then used in a credit lending decision process, how much money to lend to a particular person. And they've got and then the other part of the business is software, and that part of the business is also very entrenched with large financial institutions for risk management, fraud detection, all basically decisions around credit management and decision making, and that's the two businesses that they operate in, and they're approximately 50-50 in revenue. But one business has sort of been driving a lot of the earnings growth, and the other business has been in reinvestment, which has been sort of hiding the true profitability of the underlying FICO business.
And what sort of market share does the credit score business have over in the US? Because it's pretty impressive.
Yeah, so I would say the scoring business, the actual giving FICO scores to the US consumer, is like the operating system for the US financial system when it comes to household credit. They have approximately a 90% market share when it comes to the FICO score. When a score is requested, it's north of 90%. When it comes to credit origination and when it comes to buying, household debt in securitized debt, they have probably a 99% market share. The regulator wants to keep on top of the whole US financial system, so FICO becomes a very simple and easy way to keep on top of bank credit risk, household credit risk. And so as a result, it's sort of, in all of its sort of aspects it touches, it's north of 90%. So this is a great position to be in. And it took perhaps many decades to get itself into that sort of position.
And it's, I guess, gives them incredible pricing power, which is something they've just started to leverage a little bit more recently. What can you see them doing in terms of prices going forward? And is there also a risk if they push that too far, they could run into some regulatory antitrust concerns?
Yeah, so taking a step back, what I like to think, how I like to think about a business is, how important is this business whenever there's a sort of downturn and a recession. And in every recession you've had in the US, the need for FICO has gone up, and so their market share has gone up. So let's say just the most recent financial crisis we experienced in the US in 2008 and 2009, a lot of lending institutions got sort of caught with poor risk management systems, and the government of the United States made it compulsory that any mortgage originated from a US bank would have a FICO score attached onto it if that loan would end up in Freddie or Fannie's balance sheet. So the market share has gone dramatically up over the past decade, 2 decades, because it's become mandatory, right? The regulator is telling you we need a FICO score if you want to originate a mortgage. Now that same requirement isn't on auto loans and credit cards. However, there's a huge network effect, scale effect, if you are using one scoring system, and it makes it easier for the regulator as well. So they've built a lot of market share, and as you rightly point out, they have pricing power. However, I would say this, they haven't actually executed pricing power for a very long time. So they've only been pushing pricing over the last 4-5 years. But for the 25 years prior to that, they actually didn't lift pricing. And when I mean not lifting pricing, they actually didn't even recover inflation. So the average cost of a score is about $1. And when you think about the cost of a mortgage closing in the United States, it's about $4,000. So we're basically talking about basis points of cost in the overall system. Even if FICO was to double pricing tomorrow, we still think it's very doable. It's not a big cost to the system. And these scores aren't actually you just don't purchase a credit score, you actually buy a credit report. So FICO sells the score to a credit bureau, and the credit bureau then goes off and sells a report. So that's probably sold for $100 to $150. So FICO's making about $1 as part of the $150. And so the way we think about it is that a fair share, given FICO's the reliance the system has on FICO? Are they getting their fair share in terms of that sort of profit share, let's call it, or revenue share, let's call it, with the credit bureaus? And we think that's still very low. And as a result, pricing is basically still got a long way to go, because they still have 30 years of pricing to catch up on and inflation to catch up on.
And in terms of AI, is AI a risk to disrupt FICO's business model, or do you see it as an opportunity to increase margins, or perhaps even it's both?
Yeah, so I would say it's an opportunity, and that probably wasn't the view a year or two ago, where the concerns were that financial institutions, particularly newer financial institutions that were looking at credit lending decisions themselves, were going to use their own proprietary data to make lending decisions. The problem with that model becomes that ultimately FICO gets to see a wider range of data from all financial institutions, so it can build a much more encompassing a view on the US consumer when there's a credit decision to be made. So typically what we think will happen over time is that there will be more fintechs or institutions that want to go into credit lending that will actually plug into the FICO ecosystem and will actually want a FICO score as well. And then secondly, lending is one of those industries. It's very regulatory intensive, very capital intensive. So, the regulator, once you become a certain size, if you're making lending decisions and you're going to lend money out to people, the regulator wants to see what were your underlying metrics that you used and what were your risk management systems. And again, we think FICO benefits from that, being the industry standard, being the operating system of the US financial consumer. They benefit from the fact that if you input FICO scores into your credit decision systems, you can actually then give the regulator some comfort that you're making prudent lending decisions. So we think it's more of it will benefit them. But having said that, majority of lending that happens today in the United States economy is done by traditional banks. It's a very capital intensive business model and does make it hard for fintechs to really make much of an impact in the overall market shares and dynamics.
And you mentioned their software division at the start, which they're reinvesting in. I think that includes some fraud detection and customer management software. Where do you see that in the cycle, and can that start to become a material contributor to earnings going forward?
Yeah, that's an interesting part of the business that perhaps gets less attention. So what this business basically has been in historically is a software, a very mission critical software system where largely on-premise. So it's been moving to the cloud, but it's been largely an on-prem software where a financial institution inputs its data, and based on certain rules and decisions, it comes out with a credit decisioning system. So let's say in fraud detection, if you're an ANZ Bank customer and you're tapping away on your ANZ Bank card, but then all of a sudden there was some irregular activity on a gaming website in Europe, FICO's credit fraud detection system would alert the bank to say this particular consumer's details may have been, stolen or being used in a different sort of venue that the underlying client's not using it.
So they're the ones sending me a text message ruining my ability to use the credit card when I'm trying to buy something online, are they? I'll just cut you off there for a second, Sonny. We'll be back with more Talk Your Book after this short break.
On TV, online, and on your smartphone. This is Ticker News.
This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk, and financial solutions.
Yeah, Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
This is Talk Your Book, and we've got Sonny Bangia from Black Wattle Partners. Sonny, before the break, you were just walking us through their FICO's software business and where you think it's going next. If you're able to just pick up where we left off and how you think that business is going to progress in the years ahead.
Yeah, thanks, Chris. I think the software business is another very interesting part of FICO. This business, as mentioned earlier, is in a reinvestment period. So we're not seeing the true margins of the business today, which is kind of, as a result, hiding a lot of profitability inside FICO. It's approximately 50% of revenues. And what this business actually is, it's a mission critical software business that banks and financial institutions use to make better credit decisions, whether it's fraud detection or just general marketing campaigns on their existing customers, or it is just generally just having a better sense of making the credit decision whether their customers are seeing wages go up and whether we should lend them more money, or whether they've lost their job and we should be cutting off lending limits. So that's what the software does. And it's been largely an on-prem business, which is migrating to the cloud. Now, on-prem, it's still a very robust business. It's got a lot of very high retention. It's growing high single digits in the on-prem side, but it's actually the cloud side, which is really exciting. As they have migrated a lot of that software for their customers to a cloud platform, it's resulted in a lot more spend on the software. So you can think of this as much more of a traditional SaaS business where revenues are growing at about 30-40%. Existing spend on that SaaS business is growing at about 20 to 30%. So as a standalone business, Chris, it would be probably one of the fastest SaaS companies in the US. Very, very high quality revenue, repeatable revenue streams. But actually, what's really interesting is, as clients move to the cloud offering, they spend more. So the NRR on that, the net retention revenue on that side is north of 25%. And when you look at businesses around the world that are generating an NRR greater than 20%, they're typically trading on pretty aggressive revenue multiples. So we're not really seeing that being priced in to FICO. And so what's actually happening in FICO is FICO's using some of its profitability in the scores business to migrate to the cloud. So as a result, margins in the business are being understated, and that's actually creating the valuation opportunity as well.
And so I guess that explains how you get comfortable with an EBITDA multiples in sort of the mid-30s. What sort of top-line growth would you need to see to remain comfortable with that? And where do you think the margins can get to in, say, the next 2 to 3 years?
Yeah, sure. Maybe I'll start with margins first because, the scores business, if we think about S&P and Moody's, which are the other scoring businesses that investors are familiar with, but in the corporate side, those businesses compete with one another. In the case of FICO, it's the only game in town. It doesn't require a lot of human capital to run a scores business. So we think the margins of a scores business could be close to 80%. So it's really the software business that is pulling things down. And that's fine. I think that's necessary as you migrate from on-prem to cloud. But we think that cloud business or that cloud migration will run, will obviously be a growth driver for the business. But the margins we think will improve as more customers move across. And so the overall margins in FICO we think are probably more closer to 55%, 60%, which would put it in basically best in class in that category of companies in that scoring and software system businesses around the world. So just now coming to the top line, so we think margins will improve because we think the underlying businesses have a higher margin trajectory, but they're reinvesting. So the reinvestment's largely happening in software. What feels us very confident is that banks and financial institutions always want to hyper-personalize their customer's experience. And what FICO does, it allows for hyper-personalization of the client. So for example, Chris, let's say you got a pay rise, you're looking for a home and you got a pay rise. Your bank wants to know that, and your bank wants to know that so that they can, contact you and offer you a greater credit card balance, more spending power, maybe refer you to the private bank, maybe offer you a larger mortgage redraw. So it creates more engagement with you. And that's what FICO's software business allows for. So that's where we think the growth in the software business probably can continue in the 20s, probably will slow down eventually into the teens, but the business will be a lot larger. It could double in size in terms of revenue before that slowdown really occurs. And then in the scores business, the actual original credit scoring business, well, we think pricing, we're only 5 way into a probably 20-year pricing journey. And FICO's very cautious in how it raises pricing. So the way I would sort of characterize there is where they think the demand is inelastic, they will raise prices more aggressively. So mortgages, where they are by law mandated to be the preferred or the only scoring platform in the US economy, we think prices there can rise by 20-30% on scores. And then on the mortgages, and then on non-mortgage, we think that's probably more akin to high single digit to low teens, where they think their fair share relative to the credit bureaus makes sense. So the overall business probably can still grow revenues into the mid-teens, and if margins gently keep improving, which would largely be off the back of the software business improving its margins, we think earnings can grow at the 20% mark. So that's kind of how we think about it over the next several years. And it's rare to find a business like FICO where it has such a dominant position in its core market with so much latent pricing power.
Absolutely. Well, that's sounds like an incredibly high quality opportunity and incredibly well articulated as always, Sonny. So thanks very much for coming back on Talk Your Book, and best of luck with the new fund.
Thanks, Chris. Thanks for the opportunity.
You've been watching Talk Your Book. We'll be back with more this time next week.